Okay, good morning, everyone, and welcome to Macro Race's Canadian CPI prep. Hopefully, you can hear me. This is your host, Tony. Hopefully, you can also see the screen clearly as well. So, we've got about 30 minutes till we get the Canadian CPI release, where the forecast is expected for the CPI year on year to head higher to 8.4%, with the month on month to head lower to 0.9% from the prior of 1.4%. But first of all, what I'm going to do is I'm going to run you through the release, what it means, and what is the sentiment surrounding Canada at the moment, and what are the other triggers to look out for, and then we'll go through the previous market reactions and the deviations. So, Canadian CPI then. So, what is CPI? So, it measures the prices that consumers pay for goods and services. And why is it an important release? Well, the main reason is because the central bank focuses on the headline and core inflation readings. So you're, of course, looking at the CPI month on month and year on year, and also the core inflation reading of the Canadian CPI trim, right? And also the Bank of Canada provide their own core CPI data as well. So that's why it's important. And then if we're looking at how CPI affects the markets generally, so with currencies, high inflation reading is generally bullish for the Canadian dollar. The reason being is because that if you do get a high reading of inflation and central banks' focus is to try and slow down inflation, which is what it currently is at the moment, then a higher inflation reading would mean that they'll take stronger action to restrict or try and dampen inflation pressures as much as they can. And then for bonds, what it can mean is that for the high inflation reading, it can lead to high yields. Of course, when the interest rates are raised within any central bank, the short-term rates are where any central bank has the most control over. Right, the longer-term rates are left to the traders, and when when the interest rates rise, and then the short-term rates also see a big appreciation. Right, and usually when you do get high interest rates, that's when some people see it as that we may be in a recession territory, or maybe headed towards a recession. Maybe the economy is overheating a bit too much for the central bank, so they need to take aggressive monetary policy action to try and restrict that strong amount of growth or high inflation readings as much as they can. So for bonds, high yields usually occur when you do get a higher inflation reading. Of course, and vice versa, with bond prices, they also head lower as well. Now, for the stock market, so the stock market, if you don't know already, when you do get high inflation prints, you see lower stock market valuations, particularly the indexes as well. And on all those cyclical stocks, right, the ones that do well during a good time or towards the peak of the business cycle when the economy is up and running. Again, consumer spending is quite strong. So for stocks, when you do see high inflation prints and the central bank has a focus on it during a tightening environment, that can lead to depreciation in indexes. And we've not only seen that in Canada, but in the likes of the US as well, and also in Europe and the UK and other economies such as in Australia and New Zealand, just to name those major central banks. So for the stock market, high readings can mean you could see a more of a bearish reaction to the market. Now, the previous report for the consumer spending, so consumer price inflation accelerated to a four-decade high. It was the highest since 1983 and far exceeded economists' expectations of a 7.3% increase. So in May, the inflation gauge rose to 1.4% from the prior month, with gasoline, hotel rates, and automobiles among the biggest contributors to the increase. So the average core measures of inflation, which is often regarded as a better indicator of underlying price pressures, rose to around 4.3%, was 4.73%, which is a new high in data dating back to 1990. So very strong very strong inflation readings that we had from not only from Canada but also in the US as well. So hopefully, so that's what the previous report had shown. Inflation was still ticking up quite strong. Gasoline, hotel rates, and automobiles being the biggest contributors. Now, the credibility then of the central bank. So this is something that was a surprise to the markets when we had the rate decision from the Bank of Canada. Of course, inflation, as said, it reached a fresh high for them at 7.7%, for a fresh 30-year high. And what happened was that the central bank had decided to, instead of going for a 75 basis point hike, which everyone was expecting from the Bank of Canada, they went for a 100 basis point hike, which is unprecedented. I mean, it has happened in the past before with other central banks, noting the Federal Reserve, but this 100 basis point hike, this mega rate hike that the Bank of Canada took the markets by surprise. So what happened off the back of that was that the Canadian dollar had really strengthened quite a bit off of the back of that data. So if I just bring up the Canadian Bank of Canada rate decision, I'll just kind of go through some of the deviations just briefly. So off the back of that 100 basis point hike surprise, we'd seen on the dollar CAD, there was about 80 pip move down. On EuroCAD, 88 pips down. CAD JPY, 68 pips up. Aussie dollar CAD, about 54 and a half pips down off of that data. And GBP CAD had seen the biggest reaction out of everyone else, with a 99.8 pip move down off of the back of that 100 basis point hike surprise from the Bank of Canada. So the credibility, the reason why I'm talking about it for inflation, with the inflation report, is that the markets are looking for the central banks to, they're expecting these central banks to tighten monetary policy very aggressively, right? And if inflation does get out of hand or does become unanchored, then central banks will need to take stronger action to do that. So markets would expect central banks to do that. So with a 100 basis point hike, yeah, I mean, everyone was expecting 75 basis point hike. It does kind of take away the credibility away from the Bank of Canada, knowing that they're having to take stronger rate hikes than people and economists and traders were expecting. But it is, in their eyes, it was something that was necessary to do to try and control inflation. So that's why, of course, inflation reports that we're going through with MacroRace. You see the data on the Financial News website. It's very, very key to how the markets will react in the short term, and then also, of course, in later on down the line, as markets start to price in maybe stronger rate hikes, or where maybe what the next rate hike might be. So, of course, the original forecast for the rate decision was for a 75 basis point hike to 2.25%, but then it actually hit 2.5%. Okay, so the prior being 1.5%, with a 100 basis point hike that we had from the Bank of Canada. So the credibility dwindled a little bit from what the markets were expecting, but it is something that is necessary to try and control inflation pressures. And we'll go through some of the Bank of Canada comments that they had said at the meeting that they had, and then go through some of the other later comments as well. So let's go through that. So this was the market reaction off of that data there. So you can see that the Canadian dollar had seen some continued strengthening, and if you were looking at the market reactions, it took about nearly 30 minutes for it to start seeing some more of a headway towards the downside there. But again, the market's reaction was quite strong to that, and the Canadian dollar held with the strength for quite a long time, compared to when you do see expected rate hikes and everyone's priced in the rate decision. You usually see, you might see a little, you see like a jump up and then move back down, and then it'll kind of just carry on the way it is. But with the surprise that we had seen from the Bank of Canada, that Canadian dollar strength had held. So what was the comments then? So July 13th on the rate decision that we had, so last week. So what they said is that they had underestimated inflation since the spring of last year, and that was owing primarily to global factors, of course, the Russia-Ukraine conflict and how that affected gas and energy prices, and how that of course led to and also agricultural prices for wheat. So sunflower oil, I couldn't get sunflower oil for ages in my local supermarket because of course Ukraine is the large producer of sunflower oil, and of course they weren't exporting. You weren't able to get that. So there were also the agriculture food price pressures that were also coming in too. So what they also said is from the Bank of Canada is that they said high commodity prices and increased supply constraints and rising shipping costs account for around 2/3 of the missed inflation. So they've missed out a huge chunk of, from the inflation reports that we'd seen previously, what had been stated in those reports. And they basically, as said just here, they've underestimated how strong inflation was going to be. Remember last year, a lot of the government officials and central bankers were saying that inflation is going to be temporary, or it's transitory, i.e., it's not going to last. It's going to have a huge rise, it's not going to last that long, and it's not going to become entrenched. But this is something that the Bank of Canada was worried about, and hence they taking a 100 basis point hike. Is that because they were worried that inflation could become entrenched, and also the expectations for where inflation goes to in the future as well. That you could see higher levels of inflation readings that are going to be entrenched into the Bank of Canada's future forecast. But they also said that they wanted to front load the route or the route to high interest rates in the face of excess demand and high, widening, and persistent inflation. And they expect inflation to average 7.2% this year, up from 5.3% in April. So, of course, a big jump that they missed out from their expectations. 4.6% in 2023, up from 2.8%. And then getting close to their 2% target, or they see inflation at 2.3% in 2024 versus 2.1% in the previous report that we'd seen, or previous report that we'd seen in April from the Bank of Canada. But all you've got to understand is that, markets, Bank of Canada is expecting inflation to become entrenched, and that will lead to higher rates of interest and surprise rate decisions that we had seen from the Bank of Canada. But not also the Bank of Canada. You've seen it in other areas too, with the Swiss National Bank trying to make sure that they're following in step with the Federal Reserve when they had hiked by 75 basis points rather than 50. And then the S&B had taken their surprise 50 basis point hike to minus 0.25% from minus 0.75%. So that's what you got to understand from the Bank of Canada. So Macklem, what he said is that the fact that the Canadian dollar hasn't appreciated as much as expected suggests that interest rates must be tightened more. So inflation readings, of course, are going to help with that. If you do get higher than expected inflation readings, then of course the central bank is going to look to try and bring up the Canadian dollar's value to where they would want it to be. And again, the goal is to swiftly raise rates to the high end or slightly over the neutral range, which is around the 2% or 2.25% range, is what's been cited before in the past. And then the Macklem said that the 100 basis point hike reflects increased concern that rising inflation may become entrenched. So what I'd said before. But again, the key thing is they don't want it to become entrenched, because if it does, then, of course, then if they lose control of inflation, spirals out of control, you could get a Venezuela on your hands, or Turkey situation. You could be cooked up, and that's it. You're done. Your inflation has skyrocketed to the likes of 69% as well. So that's what they, of course, hopefully wouldn't happen within the developed nations, but just something, of course, just really going to the extreme is what I'm trying to insinuate there. Then where is the economy at the moment? So of course, inflation at 7.7%, prior of 6.8% with the prior release. GDP quarter-on-quarter annualized rate at 3.1%, prior of 6.7%. Employment change ticked much lower to minus 43.2K versus the prior of 39.8K. Average hourly earnings, of course, a key thing, of course, making sure that there isn't a wage price spiral. And another thing that will add or contribute to the inflation reading and central banks' actions when they decide where monetary policy should be. So it came in higher than expected at 5.6% versus the prior 4.5%. The unemployment rate of 4.9% versus the prior 5.1%. The raw material price index also ticked higher to 2.5% versus minus 2%. PPI year on year ticked lower to 15% versus 16.4%. And of course, the overnight interest rate or the central bank rate at 2.5% versus 1.5%. So that's where the economy is at the moment. So the reason why we're looking at these indicators is because, of course, if you have more people that are employed, that means that means that there are more people with money in their pockets to spend on goods and services, and how productive the nation is as well. Of course, if the nation is very productive, that can also add to Canadian dollar strengthening too. And then the unemployment rate, of course, similar thing to the employment change. If you have less people that are unemployed, then that means there's more spending that there's potential for. And then the raw material price indexes and the PPI or the producer price index for Canada, that's also going to be very important too, because if producers are paying more for the goods that they're making and raw material prices are seeing an increase as well, and then that means that at some point in the future, those price increases that producers are facing could be passed on to consumers as well. So again, that's quite a key thing just to understand and bear in mind. Of course, it doesn't mean that if you do get a higher reading for 1 month, that is going to be passed on straight away to consumers, right? Businesses aren't, focused on, okay, there's 1 month of data that's just said that PPI is really, really high, so we're going to increase prices. No, the business has to kind of take time to look at the different, look at prices that consumers are paying for their goods or services, and then make a decision whether or not to slowly increase price for their goods or maybe take a major leap later on down the line. So that's where the economy is at the moment. It's quite key to understand where inflation, could be headed. Hey, FX Buzz. Oh, hello. So I just kind of missed a chat there. So going on then. So the triggers then for the economic release. So according to economists, they see a high estimate for the month at 1.2%, so 0.3 deviation, with a low of 0.4%, so 0.5 deviation on the low end. The year on year, they're expecting a high end of 8.9% with a low estimate of 7.9%. Of course, the current forecast for Canadian CPI year on year is 8.4%, so looking for 0.5 deviation on the high end there, and then looking for again 0.5 deviation on the low end. So now, investment bank views, what are they expecting? So CIBC, so on the 18th of July, they said that domestic CPI is the focus for the week, and they anticipate a plus 1% month-to-month increase due to higher gas prices. So they're expecting it to go to 2.4%, right? Not looking at the forecast. They're expecting it to go to, they're expecting a plus, a percentage point increase to 2.4%. And then Scotiabank, they say that given with the persistent strength of inflation, they expect the Bank of Canada to raise their policy rate to 3.5%, and are maintaining that through 2023, which is 50 basis points more than the last forecast. So of course, they're expecting 3% for their where the Bank of Canada would set their rate by the end of the year. But of course, that's gone up, of course, off the back of the central bank taking that 100 basis point hike, that surprise hike. Then if we look at the previous market reaction then, I'll play this video for you here. Okay, hold on, let me just make that big. Okay, so about 10 seconds before the release there. And what you'll see, of course, with a high inflation print, you will see there we go. So the Canadian CPI month-on-month was a 0.4 deviation. And the Canadian CPI year-on-year, it's seen again a 0.4 deviation too. And again, so the overall the data was strong for the Canadian inflation data. Now, the only other key reason as to why you didn't see that continued sustained strong movement towards the downside is because some of the other inflation readings, so as the Canadian CPI trim, which is regarded as the core CPI from the government, didn't tick higher, or it was more or less in line with expectation, as you'd seen with the Canadian core CPI. Again, I'd also seen a tick down by 0.2% compared to the prior. So you didn't see a strong hold. Of course, the markets, of course, Canadian dollar did strengthen off of that, but you didn't see a strong hold of that initial movement towards the initial strengthening of the Canadian dollar on the first candle. It kind of had its initial reaction, boom, and then peeled back some of its movement. So if I kind of go on a little bit more, you can see it did kind of start, it didn't, the reaction. So after about maybe a couple of, so about, that's about 3 minutes of trading, about 3 or 4 minutes, then it started to move back up. So kind of go back, go forward. So yeah, it didn't last too long, that reaction there. So then if we kind of look at the deviations, the kind of markets just kind of continue their pace of what they were going at beforehand. We have a look a bit more. Okay. All right. So key thing you've got to understand, so just let me re-clarify that. So you'd seen that initial reaction, it didn't, on the initial reaction, continue to see some further moves towards the downside from the first candle, kind of pop back up, and then try to move back up before the prior to the release, where it was prior levels. Didn't happen on GBP-CAD. But as you can see on the dollar CAD, that had more or less erased this initial move towards the downside. GBP-CAD, as I said, had the, if we look at the deviations then for the Canadian CPI. So the biggest market reaction that we had seen was from GBP-CAD. So let me exit this here. Okay. So if I bring up the deviations, right, here we go. So as I said, the biggest market reaction was from GBP-CAD, which had about 19.5 pip move towards the downside. Then we'd seen that the EuroCAD had seen the second largest reaction with about 18 pips down. So after about 10 minutes of trading, remember that's what the brackets represent, we had seen about 12.6 pips down, and GBP-CAD still had the biggest move compared to everyone else of 12.9 pips down after 10 minutes of trading. So that's where the for these three here, let's say with CAD JPY, GBP-CAD, and EuroCAD had the biggest reactions compared to the others. So dollar CAD had seen about 15.5 pips down, and then it was flat after about 10 minutes of trading. So again, of course, you had the 2 bits of data you had there. Data had met the 0.4 deviation, and these three had seen the biggest reaction out of the rest of the other currency pairs that we had measured. All right, so okay, I think the key thing is, as said, if the, well, of course, with the markets and with oops. Excuse me. So with the with what the triggers are then, and what the traders and what the economists are expecting, looking for that point, you're looking for about, they're looking for 0.3 deviation. I think we'll still hold on to what we had looked at before for 0.4 deviation to get the reaction we had seen similarly last time on both the bits of data for the CPI month on month and year on year. So again, a 0.4 deviation is what we'd expect to look, what we'd look out for, to expect a stronger reaction from the markets, or similar reaction to what we've seen here with USDCAD being the biggest, what we'd seen in the past as well, being the biggest market or biggest reactor to the release. Again, in the previous releases too, had always seen the biggest reaction compared to the Canadian dollar. All right, so we've got about 5 minutes left, and what I'll do is kind of get my tick strike open up. Ready for that. So, so key thing is about financial juice. The reason I think the key thing is, so financial juice, if you haven't used a real-time voice and text service or never come across it, hopefully you guys have, if you've been watching my videos. So real-time voice and text service, or this is something that an investment bank uses to manage their trades, capitalize on potential trades as well. And they also listen out for key comments that could come from central bankers, that fundamental news that those investment banks receive. That is something that always moves the markets and has can cause big swings. So if we're kind of going down a little bit, so we can see that we have this headline here that the Russian Foreign Minister Lavrov said that geopolitical objective of special operation in Ukraine have changed from just DPR and LNR to a number of other territories as well. That's according to IRA. So this is how the market reacted. So you had the Euro 10-year bond, the Euro 10-year government bond that had the yield had declined on that. The DAX had also declined too, and the Euro had also declined. Of course, that's something that you won't get anywhere else with the market reaction. And the level of detail that we provide you guys, of course, will help you to hopefully manage your trades better or capitalize on potential trades as well. So that's something that Financial Juice provides. Now we have a 7-day free trial of Financial Juice Pro that you can use. So remember, the key difference between the Pro and Light version. In the Pro version, you don't get any adverts, no delays to the website, and you can also look at set your economic triggers as well. So if we had, let's say, a buy alert, say I put it at, and so I did 1 spot 2%, for the high end, for me to buy the Canadian dollar. Just as an example, nothing. Of course, you guys have your own thing that you want to set and do. Ignore this number here. That's just showing the forecast for the figure. Then once you've set that, you save it, and then we put the other bits of data in too. So let's go. All right, let's do that. So then once you've set that, and when the release comes out, and what it'll do is it automatically or straight away come out with the, as soon as the data comes out and it meets your trigger for the release, then it will come up with a buy or sell alert here for you, depending on what you want to do. Okay, so we got about a minute and 30 seconds before we get the Canadian CPI data. Hopefully everyone can still see my screens okay. I've got my tick strike open up and ready to measure the amount of momentum that there is on the Canadian dollar against the, of course, with the other currencies as well. Right. Okay. 1 minute go now. So remember, the median forecast, of course, is spot 9%, with a prior of 1.4%. And for the year-on-year, the median forecast is 8.4%, with a prior of 7.7%. Of course, if you do get a high inflation print, you'd expect the Canadian dollar to strengthen. But if you do get a low inflation print, then you expect the Canadian dollar to weaken. All right, 30 seconds to get the data. Ten seconds. spot 7%, lower than the forecast of spot 9%. Canadian CPI year on year 8.1%, lower than the forecast of 8.4%. With the Canadian PPI month on month minus 1.1%, minus 1.1%, lower than the forecast of minus 0.5%. Canadian CPI trim 5.5%, lower than the forecast of 5.6%. Canadian CPI median 4.9%, lower than the forecast of 5.1%. Canadian CPI common 4.6%, higher than the forecast of 4.2%. Canadian core CPI month on month, spot 5%. So the Canadian dollar weakening there off of the back of that data. Okay, so we're looking at GBP CAD, dollar CAD, Euro CAD. I also want to get CAD GPY actually. So let's get that up. Right, there we go. So it moved, Canadian dollar weakened off of the back of that data there. So there's a 0.2 deviation on the month on month and then a 0.3 deviation on the year on year. So you can see you have that market reaction you did see that initial move towards the upside off of that lower than expected inflation reading, but we didn't get a 0.4 deviation on the month on month data, neither on the Canadian Canadian CPI year on year, and also didn't meet the high and low estimate or high estimate or low estimate for the Canadian CPI data from the Economist either. So not seeing a sustained, actually it's more or less just done its reaction now. So I think if experts are saying who's doing the market, who's doing the voice, that would probably be James from Financial Juice doing the voice there. All right, so let's do a quick measurement then of this here. So what I'm going to do for the dollar CAD, I want to measure the initial strength that we had seen off there, because that's what did happen. So go look. Candle. Right, so there's about 11.5 pip move towards the upside on the initial move. And then after that, we'd seen about 4.3 pips down. Okay. USDCAD, let's have a look at you. Okay. We also want to see, we'll expect to see, hoping to see any comments from central bankers or markets to see whether they're pricing in a smaller rate hike from the Bank of Canada rather than a 100 or even a 75. Probably looking for a 50, maybe. But again, key thing is prior figure. It was the Canadian CPI month on month was higher than the prior figure at 8.1%. And however, the Canadian CPI month on month or the short term trend for inflation did tick much lower from that data there. It's about right. So GBUSD or GBCAD. See what you did. Okay, so about 13.5 up, 13.7 pips up. CAD JPY. Okay, still holding down. That's about 13.3 pips down. EuroCAD, where are we? There we go. All right. It's about 11.1 pips up back of that data. Okay, I also want to measure NZD, AUD. Oops, excuse me, AUD, NZD. Oops. NZDCAD. Apologies. All right, so it's about 9.8 pips up. We can just round it up and just say 10 pips up if you wanted. Okay, same reaction. And we've got one final chart to have a look at. Probably compared to what we'd seen last time, CAD Swiss franc is probably going to have the smallest reaction like it did last time. But hey, let's measure it anyways. Yeah, a measly 7.4 pips down. So then, just kind of summarize what we'd seen. So GBP CAD had seen the biggest market reaction. Then we had seen CAD JPY. And then we'd actually seen dollar CAD had the strongest initial reaction, right? But then finished lower, 4.3 pips down. But of course, the Euro CAD had 11.1 pips towards the upside and is still headed up. But now we can see some further weakening from the Canadian dollar overall now of this better data. So yeah, other than that, so I think key thing is if you're looking at what I'm seeing here with tick strikes and I'll go over it again. So tick strike just allows you to listen and listen to order flow basically. So imagine you're in the trading pits of Chicago, and you've got all the guys and gals that are buying and selling and they're calling out the figures. That sound, just imagine that's translated into tick strike. So it's showing you the amount of momentum that there is behind a certain asset or instrument or asset class that you're looking at. So if we're looking at the Canadian dollar, so we can still see, so now there's a little bit of buying coming through or the bit of strengthening from the Canadian dollar, but it's not really lasting too long. So with the levels then, of course, as I said, it measures momentum of a asset class, different instruments. And you can look at not only currencies, you can look at stocks, ETFs, ETNs. If I just bring it up here for you. So here we go. So Forex, crypto, futures, stocks, ETFs and ETNs, the internals as well. And you can also, of course, if you've selected your current tickers, then you've got your active screen here. So it's kind of easier to manage. Rather than trying to, if you wanted to remove something, you just do it from here. But that's what tick strike does. So you have different levels of sensitivity as well. So one being the most sensitive. So when there's a little bit of a market reaction going on, as we're kind of seeing now, that there's continued selling on the Canadian dollar, that tick strike will go off. But if you want to decrease the level of sensitivity, and only when you want to see big moves of momentum within the market or strong moves of momentum, then you can set the level at level 15 being the least sensitive. So again, only when there are big market movements happening, only then will tick strike go off. So you can kind of compare it here. So you can see a little bit of move towards the upside here, or a little bit of buy momentum that's creeping in there on GPCAD. And dollar CAD, there's a bit of a buy momentum going there, but I've set it 15, so you're looking for much bigger moves on the Canadian Swiss franc if you want to, if you're looking to trade that. But that is ticks right there, and same thing again. We want to do is provide you with a 7-day free trial of TickStrike. Of course, have a little play with it, see what kind of fits your trading style. Again, some of the customers that we've had of customer feedback, what they've said is that sometimes they look at it to manage risk or capitalize on potential trades. If you're a scalper, that's another way that people, that's something that people use TickStrike for. But again, it's all down to however you want to use it, right? There's no one way to use TickStrike. So 7-day free trial is in that link there, or in the chat there for you to have a look at as well. Now, other things as well, of course, Macro Ace. If you liked this video and you like the content that I've put out for you, and you found it useful, then don't forget to give us a follow on Twitter as well, and like and share this video, and tell your other trading friends and partners about Macro Ace if you found it useful to trade economic releases. I think it's something that traders, fundamental news and an understanding what an economic release is something that a lot of traders look for to try and get that extra edge when they're trading economic releases or managing their trades after an economic release has occurred. So definitely share that, get the word out there that we do exist, and we're providing you with hopefully providing you with good content, and of course the mailing list as well. So every Sunday I send out a report of what to expect for the week ahead. So you can see here I've got what I send out on the Sunday of what the releases that I'll be covering, what to expect for the Asia session, the Europe and US, also the summary of the weekend news as well. I kind of come in because I'm addicted to news on the weekend, so I just kind of put out bits of headlines here and there of what matters. So this is, of course, just kind of you're getting a gauge of the sentiment before the markets open up. And you kind of expect what are the releases or the big major releases that are likely to have the biggest reaction, or have a big reaction. That's there provided with you within the Macro Ace. If you do sign up for the Macro Ace mailing list. On top of that, of course, you did see me showing you the deviations as well. So not only do I show you the deviations for Canadian data, but you've also got the Bank of England retail sales, which we used to do had a bigger reaction, last time. But so maybe another release that we do again. Of course, GDP data that we have. So we've got the advanced data, not too long away, about a week away. And then we have, the other rate decisions too. Of course, the ECB rate decision tomorrow, where they're expected to do a 25 basis point hike, both their interest rate and their deposit rate as well, and also the marginal lending facility too. But again, the deviations for that is also provided in the one email. And then finally, the upcoming streams as well, that's also provided, or the links to those streams are also provided in the mailing list as well. So that is Financial Juice, that's Macro Ace. And then finally, we have a new product that we're beta testing at the moment, which is Unusual Activity. Okay, so Unusual Activity, if you like trading unusual volume activity in stocks, then you can join the free beta test group of the new service that we currently have at the moment. So again, that's another key thing just to be aware of, that you can I'll put the link in there for you as well in the chat. But yeah, so other than that, we're covering different sectors now and different industries, and we're constantly improving it. But that's for what you guys say, what you guys want in the product. The same thing with Macro Ace. If there's something that you guys want, or if there's something that's missing, then let me know. Always give me an email, give me your feedback. It's always very important to be able to build a product or service that is useful for you guys. So that's my email there at the bottom of the chat. Other than that, ladies and gentlemen, thank you very much for joining me. Don't forget to join me for tomorrow. We have the ECB rate decision. Now, usually that rate decision had happened at 7:45 a.m. Eastern time, but now we're actually going to be getting it at 8:15 a.m. Eastern time. So start of the US session. Okay, so that's going to be quite interesting, of course, with the added volatility that there is going to be with the US traders jumping on as well. But let me pop in the link for you so you can, of course, jump on for tomorrow. So the video or the live stream will start at 7:30 a.m. Eastern time. So about 45 minutes before the release actually happens, and we'll go through the sentiment. And same thing I did for the Canadian inflation reading. Any questions? If you do have any questions, do let me know. As said, you can email me as well to my email address. I've popped in the chat as well. Other than that, thank you very much, ladies and gentlemen. Enjoy the rest of your week. It's been blistering hot here in the UK. It was, 37 yesterday? My car, just trying to get into work. It's just like you try and touch the steering wheel, but you feel like your hand is just melting. If you have any of you guys watched Men in Black, where it was the first film where Will Smith, he puts his hands on the metal ball and it removes his fingerprints. Well, that's exactly how I felt when I was trying to drive my car. It's just going burning my fingers. But hopefully you guys have enjoyed the weather, and I will see you tomorrow at 7:30 a.m. Eastern time for the ECB. Casasa Louise says yes. FX Burst says hold on. All right. Take care, guys. I will see you tomorrow.